Thank you so much for joining us. I know we're really excited to hear from you. And you also have been working on the Xoogler investments team as well, and have spent time at Google and Barclays and now at HP. And so I know that we haven't really covered this in the Xoogler school yet, and sort of students have been asking more about finance and also tech, how they intersect. And so this is a really important conversation, and I'm really excited that you can lead it today. So with that said, I'm really excited to introduce Aashna.
Thank you so much, James, and thank you for having me. I'm very, very excited to be talking to all of these guys today. So hi, everyone. Good morning. My name is Aashna Gupta, and welcome to the second week of Xoogler School and the first session of the industry overview session. Hope you guys had a fantastic weekend. So as James said, I have been involved with the Xoogler community for over 2 years now and have enjoyed every single minute of it, from the people that I've met to the opportunities that it has presented me with. It's been fantastic. I would definitely encourage you guys to make the most of your time here learning from the fantastic lineup of mentors and speakers that Chris and James and team have put together for you. So I am here to present the finance and the tech industry overview session. I have a bunch of slides that I've put together, so I'll mostly be talking for the first half, and then I'll leave some time in the end for some Q&A. The idea is to give you an overview of the kind of finance jobs that you can expect in tech, and it applies outside tech too, but given that my career has spanned only in technology, that's the perspective I'm going to be bringing in. So in no way what I'm going to talk about is exhaustive. There is a lot more that you can find, but my intention here is to give you guys a brief preview of some finance roles out there. So the next slide, about me, as I mentioned, my name is Aashna. I'm originally from India and very recently moved to London. I'd been living in the US for the last few years, first on the East Coast, and then I moved out to the Bay Area. I currently work in the corporate development M&A team at Hewlett Packard Enterprise. I've been with them for a little over a year now, and I joined this role straight from business school. I did my MBA at Yale School of Management, and during my time at Yale, I interned at Barclays in their investment bank within the tech group for the summer. Prior to Yale, I worked at an early stage VC fund and evaluated startups in India, and have also worked at a late stage consumer startup in India, where I led investor relations, Corp Dev, and FBNA for them. I know it's a mouthful, but in startups, you tend to do a 10-person job, which, if you ask me, is fantastic because it's the best way to maximize your learning in the shortest time possible. And before that, I worked at Google in the India office, where I was working in the ads business, supporting our clients and driving revenue. So more of sales and less of finance. But as you can probably tell, my career has only been in tech, consumer and enterprise tech, but predominantly in finance. Next slide, James. Thanks. So now let's talk, it's upside down. I don't know if you see.
Let me grab another, that same slide from a different location.
Okay, thank you.
I think Google flips them sometimes if you don't download them. So I'm just going to
No
download them.
problem. I think all of us now with COVID, having been doing a lot of Zoom presentations, are very adept to like a lot of technical issues. So that's fine. But while James pulls up the slide, I can still talk about it. So I was going to talk about finance and tech and how they intersect. So if I were to draw Venn diagrams, for example, of finance and tech, that intersection, you'll probably have like two buckets, maybe more depending on how you define it. But in my head, how I would view it is the first bucket would be fintech companies such as PayPal, Stripe, Square, and more unicorns that are coming up like Robinhood, Revolut, etc., that are basically making the financial services sector more accessible and making everyday things like payments, banking, investing so much easier for consumers and businesses. We also see our traditional FANG businesses venturing into the payment space with Apple, Facebook, Google, all coming up with their own wallets as well. So that is one bucket. The other one would be a lot more traditional finance roles at tech companies. And again, in all honesty, as I mentioned earlier, you can apply them across all companies, tech or non-tech. And those roles would be like FP&A, accounting, treasury, investor relations, corp dev. And some could be more advisory roles like investment banking. So my plan here is to go over most of these roles and share insights from my experience in terms of what the role means, what kind of job responsibilities you can expect for a finance professional in that role, and what a day in the life would look like. But first, before I do that, I wanted to go over the next slide, which would have the income statement. So James, do you think we'll have the slides up soon? If not, I can kind of skip. Oh,
Can
perfect.
you see this? Let me go full
That's
screen, and then we should be back in
I
business here.
do see it.
Awesome.
Fantastic. I think the slideshow or
You,
right there. Fantastic. So yes, this one. Okay. So right here, what we have is a very, very simplified version of an income statement. I just kind of wanted to ensure that you guys know some of the basic terms that you'll come across everywhere when you're hearing executives and leaders talk about financials and metrics. I'm not going to get into too many details because I don't want to bore you guys early in the morning, but just a very high level overview. So first, you see the revenue line item, and that's obvious. It's the income that a business generates from its day-to-day activities. So if you look at Google, for example, their biggest cash cow is the ads business today. So you'll see a very significant portion of their revenue coming from advertisers. Like they pay for every click or every impression of their ads across Google Search, YouTube, and their partner networks. Some of the other sources would include Google Cloud and all their other growing businesses as well. So, and for hardware companies like Apple, you'll see a lot of their revenue coming from hardware like Apple products like MacBook, Apple Watches, and subscriptions such as that of Apple Music, and fee that they charge developers for listing on their Apple Store. So that is revenue. Going to the next line, which is cost of goods sold. Cost of goods sold, or COGS in short, simply put, is essentially expenses that are directly incurred when a transaction or a sale takes place. So to give you a non-tech example, when a coffee shop sells a double espresso, COGS accounts for the price of the to-go cup, the protective sleeve, the coffee filter, your barista, the water, the processed beans, and so on. So essentially what that includes is all the people that are involved in the production of that coffee and all the materials that were needed for the production of your coffee. So what does that mean in the context of tech companies? Well, for Apple, it would mean all the raw materials that are used in producing the Apple iPhone and the people that went into that kind of manufactured and produced the hardware for you. For Amazon, that would mean the cost of delivery for every Amazon order that you place. For Google, that would mean the total cost that Google had to pay to their partners to display the ads on their properties. So I think you get the gist, hopefully. If not, feel free to ask me questions at the end. Note down everything that you guys have, and I'm more than happy to kind of take it up. Then we arrive at gross profit or gross margins, which is essentially the revenue that the company retains after incurring the direct costs associated with producing the goods or the services sold. Many tech companies are still loss-making businesses or operating profit negative businesses. So many VC funds, when they're looking at early stage startups, they evaluate the health of startups by looking at their gross margins. So now moving on to the next bucket, which would be operating expenses, which are fairly straightforward and self-explanatory. Sales and marketing primarily includes advertising and marketing expenses and all the headcount expenses for employees that are engaged in sales and marketing. Research and development, or R&D, essentially, again, is headcount and non-headcount costs for all engineering and technical employees responsible for R&D of existing and new products and services. G&A, or general and administrative expenses, is essentially all overhead costs and all headcount and non-headcount costs for all employees in finance, HR, IT, legal, you name it. We're all overheads for the business. And then from there, we arrive at operating profit, which is also known as EBIT, which is earnings before interests and taxes, which is essentially gross margin minus operating expenses. That's all I'm going to go over. As I said, this is very, very high level overview of the income statement. Moving on to the next slide, I have included a screenshot of the income statement for Alphabet, this is their most latest 10K. So 10K, if you guys don't know, it's the annual report that a public company has to file with the SEC, giving a rundown of their performance in the previous financial year. So this includes most of the line items that we kind of went over in the previous slide. It has a few more, like the net income, which is EBIT minus interest minus taxes. Every company, and the reason I wanted to show this to you is every company always has some modifications that they make to their income statement to best represent their financials. So as you can see here, there is another line item that shows the European Commission's fines that Google has been paying for the last few years. Usually, most companies consider these expenses as non-operating expenses, but given the frequency and just the amount of these fines, it looks like Google is considering it an operating expense, which is just cost of running their business operations. So yeah, moving on to the next slide. As I said, I'm going to keep the theory very, very short, getting on to things that you guys really want to know about. So moving on to the different finance hats that you guys can wear. Let's start with FP&A, short for financial planning and analysis. So now what does that mean? When I go on Google and search for it, this is what I see. Financial planning and analysis is the budgeting, forecasting, and analytical processes that support an organization's financial health and business strategy. I think that's a pretty good definition, but I don't imagine this helping you guys at all. So let me break this down for you. What do you do in the role of an FP&A financial? So FP&A professional. So when I was at a startup leading FB&A, my role essentially involved taking charge of the entire business P&L and forecasting our top line, which is the revenue, as well as the bottom line, which is the operating profit. In most cases, especially in the startup that I was working at, it was an operating loss. So, which essentially meant my job was to forecast our cash burn and help our business leaders improve our gross margins, which can then help us reduce our cash burn. To do that, I worked with different business units to identify metrics that will help them gauge their performance. So, to give you an example, we were a consumer startup, which meant for us to be successful, we needed to build a brand and brand awareness. That basically means we needed a lot of marketing, which means we're spending a lot of marketing dollars. This was one of the biggest expenses that we had identified in our business. So I worked very closely as FP&A with the marketing leaders to identify metrics that can help us evaluate the effectiveness of our marketing campaigns. My experience at Google and ads definitely helped me a lot here. But anyway, so we looked at metrics like cost of acquiring a new customer or what retention of existing customers looked like. Both of them were very important metrics for our investors as well, as it kind of indicated how expensive or cheap it was to acquire new customers, and were we able to keep our existing user base in our pool of customers, and were they happy using our services? So just like these, I worked with business leaders in different teams to kind of identify metrics for them. And with that, we ultimately arrived at what expenses would look like for the next 3 to 6 months. At a startup, you don't project for more than 3 to 6 months at best, because a startup month is almost equal to a full year in a public company. Things move very, very fast. One day you're doing one thing and the other you're just completely changing gears. While in a public company, you project for the next 2 to 3 years, as it's a lot more stable. You have to comply with a lot of regulations. You have to provide guidance to Wall Street. So it's very different in a public company. But coming back to the startup that I was working at, in terms of my experience, once we had projected our revenue and expenses, and this kind of applies across public and private companies, my job sort of evolved into tracking the monthly and sometimes even weekly performance to see if we're staying on track of the budget. Then understand what was happening, why were there any variations, if at all, and then set up meetings with management to kind of dive deeper and see how can we either control for those variances or adapt our budget to account for the new reality that we were seeing. You also spend a lot of time creating systems and processes. Your job as an FP&A manager is to identify broken or inefficient or missing processes and make them better. This may also involve working with engineering and product teams to help you build tools that can help you do a better job. Also, communication is very, very important. I cannot stress enough. Your job is to ensure you are preparing reports and communicating your analysis to all the stakeholders involved. So while it's a numbers-oriented job, FP&A requires a surprising amount of communication skills. You must be able to clearly explain financial details and concepts in layman terms to all the leaders that you're working with. And you have to communicate to your CFO with a clear projection of what is happening and what is going to happen financially in the next quarter, year, 5 years, depending on what company you're at. Again, any questions on this role, put them on the dory. I'll definitely take them up after my presentation. So moving on to the next slide. The next role that I'm going to talk about is investor relations. Again, very exciting. I worked in this role at the startup a few years ago, and now I work very closely with the investor relations team here at HPE from time to time as well. So what is investor relations? Well, like the name suggests, it involves managing communications between a company's management and its investors. Pretty straightforward. You'll see companies or companies about to go public have a full-fledged IR department. And in the case of a private company and startups that deal with investors, it's usually CFO or a team of 1 to 2 people that handle most of that responsibility. What does an IR team do? They will produce weekly and monthly reports following the markets and seeing what analysts and investors are saying and putting together summaries for the senior management to review. This also means looking at things like your company's share price movement, your competitors' share price movement, major M&A deals that are happening in the market, and anything else that's going on outside your own company that needs to be reported to the management. You essentially serve as a key point of contact for the investors. So you'll create a lot of presentations, press releases, and other communication materials for earnings release, industry events, presentation to analysts, brokers, investors. You'll provide feedback to the management regarding the investor community's perception of the market. What was their reaction? Was it good, bad, ugly? What are the next steps to manage that perception? And how do we keep the momentum going? If there have been any unexpected events, such as a rumor or a leak on the corporate activities in the news, your job is to ensure you're fully up to date by scanning through news sources such as Wall Street Journal, Financial Times, newspapers, research analyst reports, and then create a communication plan for your investors and also brief your senior leadership. At a startup, all of this is obviously a much smaller scale. My role essentially involved working with investors and ensuring that we provide them monthly updates on the business and if there was anything out of the ordinary that they needed to know, and answer any and all questions that they have on the business. And they would also have feedback on the business strategy from time to time. So it was our job to kind of ensure that they have the right channels to communicate directly with the business leaders as well and work with them to kind of fine tune some strategies and operating plans. Moving on to the next role, the next slide, please. Corporate development, or Corp Dev. So the role of a Corp Dev team is to focus on acquisitions, divestitures, joint ventures, partnerships internally at a team. In some places, Corp Dev professionals may also work on post-deal integration. So currently I'm in the Corp Dev team at HPE, and how our team is structured is that there are 2 teams within the umbrella of Corp Dev. One is the M&A team and the other is the integration team. So I'm in the M&A team, but I also work with the integration team from time to time. So to kind of define what an M&A team does, it's you work on deal sourcing, which means having a lot of meetings with a lot of potential targets, researching what's out there, and then working internally with products and business teams to understand what are your current gaps in your current portfolio, and then identifying inorganic opportunities through acquisition to kind of plug that gap. You can get your pipeline of companies through your own research, proactively reaching out to companies, and also through a lot of inbound requests through investment bankers and even your own business unit leaders who have been working with some companies and now they think it's a great idea to maybe just go and buy them. So the next step or the next another responsibility for an M&A professional is deal analysis or building a business case where you evaluate the business, build a strategic rationale, build financial model and valuation models to justify the acquisition and also arrive at a price range that the company should consider paying. This is essentially how you justify any price by understanding what that means for your own financials. Is it accretive to your growth or is it dilutive? What does that mean? That means, do you see your revenue increasing? Do you see your revenue improving? Or do you see your bottom line improving? And not just in absolute numbers, but also relatively in terms of, do your margins improve? And are we adding value for our shareholders? Then once you have all this information, you package it up nicely in the form of slides and memo and present that to your senior leadership team to get their buy-in. If the deal is large enough, a couple of $100 million, for example, you will also need to get the approval of your board of directors. So you definitely need to make sure that the work you've done is top-notch and you can vouch for your numbers, because if you're not convinced, it's going to be very hard for you to convince your CEO and your board of directors. So once you get the approvals, you issue an LOI, that is the letter of intent to acquire the business, which means you present your terms and the price to the company. Once that's been signed by both the parties, you enter a period of exclusivity, which means that the target company will only work with you and not go to any other potential buyer and provide all the data that you need as the buyer to conduct your diligence. So now the Corp Dev team will lead the due diligence and work with cross-functional teams. What is due diligence? So essentially it's doing your homework and ensuring there are no red flags. For example, the financials need to be thoroughly vetted and ensure that there is no fraud or any shady behavior or any scams. The legal team will go through all the contracts and other matters that come under their purview and give their opinion on the way the company, the target is operating. Product teams will go through the inner functionings of the code and the product architecture. The cybersecurity team will go through the dark web to understand if their security has been compromised. In short, have they been hacked before? How strong is their security framework? You guys get the point. So all functions will then conduct their meetings and analysis and present their findings at the end of the period. It's a job of the Corp Dev team to ensure that everyone's on track and also then review the diligence reports. In parallel to the diligence process, the Corp Dev team will also work with the lawyers to start drafting up the purchase agreements, negotiating the commercial terms for the acquisition. And once the diligence reports have been presented and approved, you go ahead with the signing formalities. So now, once the acquisition has been signed and closed, your job as Corp Dev is not over. And you essentially transition over to integrations, which is the second team. So for an acquisition to be successful, it is very, very important to not just buy the company, but also make sure that they're well integrated within the company. So what does that mean? You have to build plans to onboard employees in the best possible manner that delivers the best employee experience, which means building out communication plans for the employees to ensure that no one is concerned about their future, because once you hear M&A, everyone's worried. So you kind of need to make sure that you're handling this entire plan in the best possible manner. And then also working with teams internally to build out integration plans for your product, your marketing, your R&D, your sales cycle, and everything else so that they can easily just come over to your company. Once you're all integrated, which can take anytime from 1 to 2 months to 1 to 2 years, completely depending on the size of the acquisition, you need to start tracking the performance. So you go back to those financial models that were built at the time of deal execution and then track how they're doing, what the variances are, and how should we stay on track. This also helps the M&A team kind of learn from the past mistakes and kind of do better next time. So yeah, this is Corp Dev. I know I really got into the nitty-gritties of it. So Moving on, can we go on to the next slide, please? Okay, so there are a lot more finance roles in companies such as accounting, treasury, etc. But I'm going to move on to other roles outside of outside of companies, such as those of advisors, primarily because I'm talking from my experience. So, investment banking. So, what is an investment bank? It is essentially a financial services company that engages in advisory-based financial transactions on behalf of individuals, corporations, and governments. They're basically advisors to companies, advising them on financial transactions. What kind of transactions? So investment bankers advise on capital markets, M&A, and sales and trading. And that's usually how the groups are divided internally at banks as well. Capital markets essentially help companies raise equity or debt through IPO, private placements, etc., to help companies finance their acquisitions or finance their own operating needs. The M&A team works with companies as either their buy side or their sell side advisor. The sales and trading desk buys and sells equities or commodities on behalf of their clients. In addition to this, you'll also see industry coverage groups such as healthcare, industrials, technology, media, oil and gas, etc. So I worked in the tech group at Barclays in the summer, and we worked on a bunch of different things. One of the mandates that I was working on was that a company wanted to divest of one of their non-core businesses. So it was our job as their bankers to help them find a buyer. Once we found them a buyer, lead diligence, work with advisors to help draft up the purchase agreements, essentially very similar to all the things that I talked to you about in the Corp Dev role. Corp Dev is essentially an in-house investment banker for the company, while an investment banker works across companies and develops industry expertise. Recruiting for investment banking is a very traditional process. There are very few points of entry. That is, you either join straight after undergrad as an analyst or straight after business school as an associate. So that's about investment banking. Moving on to the next slide. Okay, so now I'm going to give you a quick overview of investing roles, such as private equity and venture capital. I'm sure all of you have heard of them. In investing roles, you basically identify and invest in companies, work with the management team to grow the business, and then exit the business to generate returns for your fund. So VC and PE firms both raise capital from investors known as limited partners, and they both do so in order to invest in private companies. Their goals are the same, that is, increase the value of the business that they've invested in and then sell them for a profit. VC funds provide capital to companies and they mentor startups. They invest in usually tech-focused companies that are growing very, very rapidly. And VC firms will provide funding in exchange for a minority stake of equity, which is less than 50% of ownership. Some of the examples of VC-backed businesses, any tech startup, you name it, Airbnb, Robinhood, Revolut, Google and Facebook and all these big names were also VC-backed businesses back in their times. Some of the big VC funds are Sequoia Capital, Accel Partners, Lightspeed, Benchmark. There are a lot more now that have raised funds. So you could have VC funds that are either specialists that are investing in certain industries or like fintech or life sciences, or you could have generalist funds that are investing broadly in the tech space. What does a day in the life of a VC look like? So a lot of startups are pitching to investors for investments. So meeting with founders is definitely a big, big chunk of their time spent. They're also spending a lot of time networking, again, to generate the deal flow pipeline. So you'll see them at a lot of industry events, and they'll also host a lot of meetups to find the next big thing. They also write a lot of they'll write a lot of thought pieces on industries that they're covering so that they can develop and refine their investment thesis. And a lot of their time is also spent on developing investment materials and leading an investment that they're convinced on is the next big opportunity, which means leading diligence, negotiation, presenting to the investment committee for approvals, the whole process. They also sit on a lot of boards of their investments and actively manage their existing investments by being available to the founders and helping them in any and everything that they can with operations, recruiting, basically as their sounding board. Moving on to PEs, so private equity investment firms usually take a majority stake, which is 50% ownership or more, in mature companies operating in traditional industries. PE firms usually invest in established businesses that are deteriorating because of inefficiencies. So you'll see them investing in companies that are stagnant or potentially distressed, but has growth opportunities. However, these days we also see a lot of PE funds investing in late stage tech companies as well, which is also known as growth equity investing. The structure of a PE investment can vary. The most common deal type is a leveraged buyout or an LBO. In an LBO, an investor purchases a controlling stake in a company using equity and debt, which will eventually be repaid by the company. In the interim, the investor works to improve profitability so that they can generate high returns for themselves. Some of the big PE funds are KKR, Carlyle, Blackstone, etc. And day in the life of a PE, and don't hold me to it. I've never worked in a PE fund, but I'm speaking from what I know from my PE friends, is that they spend a lot of the time reviewing opportunities in their pipeline, generating new deal ideas and reaching out to companies themselves. So a lot of deal sourcing and reviewing financial results of their existing portfolio company to make sure that they're in line with the forecast, and building models for a potential deal, and conducting a lot of market research as well to assess a company's growth potential. So of course, none of this is comprehensive. It all varies across companies, funds, roles, and I think every day is a different day in the life of finance professionals, not just investors, but all the rules that I kind of talked about. Moving on to the next slide. So I wanted to talk about why finance is relevant to you, even as you think about non-finance careers. So as a future entrepreneur, if you're thinking of starting your own business, you need to identify ideas, build a business case, which would include a rough idea of what your revenue and your expenses look like, and most importantly, having a revenue model. And then you will need to go raise capital from investors and think about how to sustainably grow your business and how to also efficiently spend the capital that you raise. So all of that involves having some idea of just finance. As an investor, you need to work with founders and businesses, identify the best opportunity for you, understand what returns you're looking for, and also how best you can achieve them, which involves understanding the financials of your portfolio business inside out. As a future product manager or as an engineer, you need to be able to run rough back of the envelope math and sometimes even build proper business cases to illustrate why you should build a certain new product or a new feature. What is the cost benefit analysis? What is the ROI? And evaluate the performance of your products using metrics that will help you understand efficacy, engagement levels, and more. Next slide. So as a future sales manager as well, you need to understand metrics to see and understand how are you contributing to your firm's revenue and what defines quota for you, what are your revenue targets based on, and also most importantly, what drives your customers' behaviors and their decision to buy or not buy, which could very well be driven by their own P&L. So that just helps you make smarter decisions. As a future marketing manager, as I discussed earlier back in my FB&A role, you'll be working with teams to look at metrics that help you evaluate the effectiveness and the reach of your marketing campaign. So to understand the cost of acquiring new customers, what the engagement and the retention levels look like, what is the lifetime value of your customers, all of these are very important metrics for marketing teams as well. As a future business leader, you will be owning P&Ls of your geography, your business segment, even your own product or function, and make decisions that can help you drive revenue, costs, and you'll be working with FP&A teams very, very closely to ensure that you're within your target. As you can probably now tell, especially after my rundown of the FP&A role, every team has a target or a budget set out for them by the FBNA team. So even a lot of your recreational activities like team offsites and dinners are impacted by the budget that is set out by the FBNA team. So it's just good to know, and hopefully you can find this knowledge helpful and useful to you down the road in whatever role that you guys choose. So generally, James, can you check if there's another slide after this? I forget. No, okay, can you go back? I just wanted to kind of talk about other things. So generally talking about finance, let's also just talk about career paths. I'm sure you're very curious to know where does a career in finance take you? So for most corporate jobs, you join as a financial analyst straight out of undergrad. And you're in that role for about 2 to 3 years, and then you move up to becoming an associate. Again, 2 to 3 years, then you get promoted to a managerial role and then move on to senior roles like director, VP, head of finance, CFO, and so on and so forth. In places like investment banking, it's a lot more structured. You join as an analyst, you're there for 3 years, and then you you decide whether you want to go to a PE shop or you want to continue in the investment bank and go on to becoming an associate, then VP, director, and then ultimately becoming an MD in about 12 to 14 years after an analyst role. You can always switch roles, careers, join a business role, own a P&L. There is no one path. Everyone creates their own path. And yeah, and in terms of other things, like how can you develop your financial knowledge? I'm sure you guys already know this, but take courses like accounting, corporate finance, entrepreneurial finance, anything finance. All of this will help you kind of build your financial foundation. And you can always continue your learning by exploring a master's in finance or an MBA or a CFA. I can't stress enough about the importance of being business aware. Read the news. That's the best way to learn the language and be fluent in business and financial terms. New York Times comes out with Deal Book, which essentially covers a lot of big mergers and acquisitions and gives you a very detailed summary of financials, the rationale, basically giving you a very quick overview of the strategy of every company. Other than that, read the Wall Street Journal, Financial Times, Bloomberg. Don't freak out if you don't understand something. Google it, ask your professors, or honestly, just keep reading about it and follow the news coverage for the next few days. I can assure you that things will start making a lot more sense then. If you're also interested in finance, and I would definitely recommend reading the quarterly and the annual earnings of companies. You can always find them under the investor relations section on any company's website. Or you can also go on to the SEC EDGAR website and search for filings. This will definitely help you give a very quick overview of how the business is performing financially, and also just a broad general overview of the business. Okay, that's it. That's it for me. I'm open to questions now. Next slide. Fantastic.
Awesome. Aashna, thank you so much. This is such an important conversation to have and sort of to center the beginning of our weeks as we get into more industry overviews. I know I'm always curious of learning more about finance. And as I've done a little bit in sales, like I'm always interested in hearing more on different roles. So I think you did an amazing job sort of breaking that down for our students. And I see questions that are coming in now. So I'm going to stop sharing my screen and then check out the Dory, but thank you so much.
Of course, I know this was a lot for a Monday morning, so I apologize, but I hope you guys found this useful.
Let me pull this up. I have one question here, which is from Renee, and that is, hello, Aashna, I'm interested in hearing a bit more about any experiences you may have in venture capital. Also, can I work in Corp Dev after undergrad? Do you recommend joining another team at Google and then applying later on for Corp Dev?
Okay, a lot of questions. I will go backward. So first I'll talk about Corp Dev and can I work in Corp Dev after undergrad? So essentially what I have seen and experienced, and again, as I said, there is no one journey for anyone. Sometimes just you can pave your own way. But traditionally, corp dev teams prefer to hire investment bankers because they don't usually spend a lot of time training you. So they prefer hiring seasoned bankers who kind of have built-in knowledge on building financial models and valuation models, and they kind of know how M&A works. So you could join corp dev after undergrad as well, but it's usually not the most traditional path. And yeah, I mean, I'm not going to say no, you cannot, but usually they prefer like 1 or 2 years of investment banking experience. And again, can I join Corp Dev if I'm in a different team at Google? Was that the question? So again, I've seen two ways of joining a Corp Dev team. One is either you come in as an ex-consultant or as an ex-banker. But I have seen a lot of internal folks move into Corp Dev teams as well. But not just in any role, usually a strategy or a finance role, but I wouldn't say that's very common for junior roles. I would say that's more predominantly common for senior roles where they've actually worked with Corp Dev parallelly to help them strategize on deals and on M&As, on targets that they've been exploring. So I'm not saying no, every company kind of operates differently. That is one definite pathway, but that's not a sure shot. This is my way to break into Corp Dev. In terms of my experience in venture capital, so I worked at an early stage Chinese VC fund back in India. I spent a few months with them before going to business school, and essentially they were setting up shop in India at the time. So it was a very small team of 2 partners and 1 analyst, and I was essentially working with the partners to kind of help develop an investment thesis. And a lot of my time was kind of spent on, we didn't have a lot of existing portfolio companies, so I personally was not spending any time looking at existing investments. So my role essentially was kind of twofold. One was finding new deals, finding new startups, which involved talking to a lot of founders, evaluating and understanding what their business model is, what their plan is, and how they plan on spending this capital. And then the other one was a few deals that we were evaluating, we were running diligence for them. So I was kind of lead on diligence and essentially working with different advisors to see how the business is operating, what the financials look like, and is this something that we think we want to be investing in? So yeah, that's my experience in VC. And if there's any specific question that I haven't addressed, please feel free to ask Renee.
Great, thanks, Aashna. Next question is, what was the most difficult decision you had to make during an M&A?
The most difficult decision that we had to make in an M&A. Honestly, I feel like every acquisition that you look at, there are new challenges that develop. But one of the most common themes is the first one, when you are thinking about just deal execution, it is, how do we stay on track of our timelines, especially as Corp Dev? You're working with a lot of different teams. And especially when you're leading diligence, you are essentially working with legal, with HR, with finance, with product, and everyone's looking at different parts of the business. And it's not a difficult decision, but it's just a challenging time. It's one of the challenges that you're working with in terms of when different teams are evaluating the opportunity, they're looking at it from a different lens. So as Corp Dev, it's your job to kind of make sure that they are probing at all the right questions and they're digging deeper where you want them to. And they're not raising red flags just about anywhere, because if there are too many red flags, you don't want to be investing you don't want to be buying a company. So essentially, I think it's about kind of maintaining your plan and working and collaborating with all these different teams when there is a very tight timeline as well, to make sure that you're able to run your diligence and present your findings to your senior management. And then another challenging point is when you're evaluating people and you're trying to decide who you should be bringing on into your company. I mean, most acquisitions you try to, I mean, the intention is always to bring in as many and most, and if not all, the people into your business. But sometimes you're also thinking about how you're building, what is a strategic rationale for you? Are you buying the company just for the technology? Are you buying the go-to market as well? Are you only buying the go-to market? So it sometimes gets a little tricky when you're working with people and you have to kind of create the best concrete like people plan to make sure that everyone kind of comes out happy in the situation. So yeah, those are some of the challenges that kind of come top of mind for me in terms of my experience in Corp Dev.
Great, thank you.
Mhm.
Let me make sure I'm getting this right. I think it's, I'm gonna mess up his name. Semanatrak. Sorry, I butchered your name. I would love to make sure I get that right on the next one. But they're asking, is finance knowledge needed to get into an analyst role, or are computational/statistical skills enough?
It's a mix. So as I said, and I mean, there are a lot of different finance roles. There are a lot of roles where you can kind of work with your computational statistical skills as well. There are a lot of data science roles within finance as well, not traditional data science as you would think about it, but you're essentially working with a lot of data that you have to kind of wean through and understand different business metrics. But I wouldn't say that I mean, let me phrase this differently. So is finance knowledge needed to get into an analyst role? Not all the times. Obviously, it's preferred, but you need to show that you're eager to learn. And you will notice startups will be a lot more open to all kinds of backgrounds. So will public companies, but it kind of depends on the team that you're interviewing for. In a corp dev role, for example, that's a hard no. You need finance skills before interviewing at a corp dev role. In other roles as well, like FBNA, it's not that you don't need them, but you need to see how willing the company is in order to train you. There are a lot of companies that kind of want to have you join the firm, have a certain solid base that they can kind of build on. And a lot more companies that are just looking for a great positive attitude and just be willing to learn. So to give you an example, when I joined when I joined the startup in the finance role, I'd been doing sales for 2 years. I did study finance in undergrad and in high school, but it had been 2 years. And I mean, I could say that, yes, I did study finance, but I'd never worked in it. But the CFO was just like, hey, are you willing to learn? As long as you're willing to learn, I'm willing to hire you. So that worked for me. So I guess it kind of just depends on who and where you're interviewing for. There is no hard yes or a hard no. You just have to kind of network your way through and see what the team is actually looking for.
Gotcha. Thank you. Question from Ben, which is, how much capital is required to get into the VC industry? Are there internships in this industry?
I don't think I fully followed the question, how much capital is required to get into the VC industry. You don't need any personal capital to get into the VC industry. And just in terms of how VCs work, and I don't know if that was the question, is VC funds usually VC funds essentially raise a fund, and then that's where they invest from. In terms of how much capital is needed to raise that fund, there is no limit. There are funds that are just $2 million funds, and there are funds which are like $1 billion funds as well. So it varies. I think it completely depends on the VC structure as well. And how that works is in terms of just how much capital the VC investors have to pay themselves and to run the operations. The usual structure in a VC fund is that you have a 2 plus 20. You have a 20%, or maybe I'm wrong actually, 2 plus, there's a certain percentage, I'm completely blanking on this right now, but there's a certain percentage, I think 10 to 20%, which is basically just management fee that the funds can basically take to pay their own salaries, to pay for rent, for their own office expenses. Of that X dollar fund. So imagine the corpus is a $10 million fund. So 10% or 10 to 20% of that would be reserved for your own capital expense. No, sorry, I am completely butchering this. It's 2% of that is reserved for your expenses, and 20% you usually get carry, which is the return you make on selling a business for a profit after you've reached a certain threshold. So for example, if it's a $100 million fund that you've raised, you get $2 million to spend for management fee in terms of running your own day-to-day expenses. And so there is no minimum threshold to raise a fund, not that I'm aware of. I have seen a lot of $2 million funds as well. There are not that many. And then it also kind of depends on the kind of companies you're investing in. Your ticket size, your check size just kind of reduces to maybe $100 to $200,000 that you invest in a single business. And what was the second question, James? There were two questions in this one question, right? One is how much capital is needed, and
the other one was asking about industry internships in the industry.
Internships in the industry. Yeah, there are a lot of them. The one thing about VC is that it's not a very easy to break into industry. You usually don't find a lot of roles just listed out in one comprehensive resource. I would suggest following all of these VC funds that you're probably interested in interning at on Twitter or on LinkedIn. They'll usually come out with internships out there, and you will find you will find funds that are hiring interns for the summer or for the entire school year or for a certain semester as well. The best way is to probably just be following them on LinkedIn and on Twitter and seeing if they come out with opportunities, because they don't have a careers website that they kind of advertise their roles on. So you kind of have to just, make your way through it.
Got it. Great advice. So then definitely start working towards breaking in sooner rather than later. Let me see here. Iris is asking, do you see people transitioning from working in the product management to venture capital? What may be some potential reasons? And then finally, what do you not like about working in VC?
Do I see people transitioning from product management to venture capital? All the time. Again, there is no one set way for breaking into VC. You have people who've been doing product management for a couple of years who transition, and some of the reasons is because they've helped build their own product and their own companies. And in tech companies, the biggest thing is about building product, right? So they're able to advise founders from their own journey, from their own mistakes and their own successes. And that kind of makes a good investor, because as an investor, you don't want to just be finding new opportunities one after the next, but you also have to maintain and spend time with your existing opportunities and your founders and your portfolio companies to kind of groom them and help them grow to the next stage. And for that, it always helps to kind of, speak from your own past experience. And that's one of the reasons you'll always see a lot of people from product venturing into VC, because VC invests in tech startups. They always need a lot of product talent as well. What did I not like about working in VCs? So there are a few things that people don't like about working in VCs. And one thing is that they're not very closely working with the business. They're not operators, they're investors. At the end of the day, you're just a sounding board. You're not actually getting very close to the business and helping brainstorm strategies and then also execute them and then really see through the success or the failure of the company up and close. So that's something that I've heard a lot of people say they miss about being investors and not working as an operator. So yeah, that's what I would say. People sometimes just don't like working in VCs.
Got it. Solid advice. Thank you. And question on the analyst position. What do companies look for when recruiting financial analysts out of undergrad? What are some qualities and skill sets they prioritize when assessing candidates?
So I've never recruited for financial and I mean, I've never recruited for this role straight out of undergrad. So take my advice with a pinch of salt. But what I've usually seen is they are looking for technical skills, at least in investment banks. I've heard a lot of the analysts tell me that there were financial modeling exercises that they had to complete before during the time of their interviews in a certain period of time. And it was like time sensitive. So I would say the one big thing is kind of looking for a solid foundation and willingness to learn. I think that is very important that you have the right attitude, because everyone understands that no one, when they're joining a company straight out of undergrad, knows anything. But they're looking for, hey, you have the foundation that you kind of learned in undergrad, in terms of like you took a few accounting courses, you took a few finance courses, and you're able to answer some of the basics, so that you're not asking, hey, what is COGS, in your interview. You should be able to answer all of that. And yeah, the right attitude. I would really, really highly stress that, because in finance, it is a high pressure job. And the reason for that is you're essentially working with numbers and you're dealing with money. So all the decisions that are kind of made are based on financials, right? So any bad decision that's made because of your analysis is not to be taken like lightly. Like, yes, there are mistakes, but there isn't a room for a lot of mistakes. So the expectation is always for you to be on your A game, and which means you're kind of working in a high pressure job environment from time to time when the stakes are high. So they want to make sure that you have what it takes and you wouldn't break in such an environment, and you just have the right attitude to kind of keep going, stay positive.
Great, thank you.
Mhm.
I think we have a couple more questions here, hopefully that we can get to before the
Of course, and if I don't answer any questions, feel free to reach out to me on LinkedIn as well. More than happy to kind of help you solve any questions or any like doubts that you guys have about finance.
Awesome, thank you so much. Question here, which is, I'm interested in investing and learning more about how to read financial statements of companies. Do you have any advice on how to go about this? Are there blogs, courses that you recommend, or groups that support such learning?
I'm sure they're out there. I would be surprised if there aren't. In terms of courses, I would very highly encourage you to look at courses internally in your own university. That's the best way. You have professors, and you know, who've been doing this for years, so they are going to be your best resource. So I would definitely highly encourage you to explore those courses in university. But other than that, I'm sure there are a lot of Coursera courses as well that you can find on um, just foundational accounting finance knowledge that you can kind of brush up on. And in terms of how to read financial statements, to be honest, the first few that I read, I had no idea what I was doing. I was just literally staring at pages and just reading at words that just kind of bounced off my brain. Just read one, two, three. Don't, these are really long financial statements. They're about like a couple of hundred pages long at sometimes. You don't have to read all of that. Just read the first 10 pages. You'll get the good gist of a company and how they work, and read a lot of them. Also try to listen to podcasts. There's also this MSNBC show that Jim Cramer hosts, which is called Mad Money. I would definitely recommend listening to that or watching that, because he talks about about different company financials, statements, and just the financial news from every day. And he explains that to you very well as well. Again, the first time you're going to hear it, you're just going to be like, what? But keep listening to it, and you'll slowly just build on that knowledge, and it'll start slowly making sense to you.
Awesome. I think we can round out here with one final question, which is kind of a general question that hopefully a lot of students have on their mind. And that's, how do I get into finance if I didn't specifically study it in my school? So what are your practices for that?
I think the best thing is take courses online. As I said, that's the best way to kind of get the basic foundational knowledge that you need in finance. It's not rocket science, but you do need to put in the hours to kind of understand how accounting works. That's just fundamentals. You may not end up working in accounting, but you need to understand what that means and how that works. So I would definitely recommend step number one for you is to take a course online. And then wherever you do end up working, see if you can get yourself involved with projects, maybe with finance teams. I know Google does 20% projects, so see if you can get kind of involved in that. And if you're working at a startup, in a startup, you can pretty much do anything and everything under the sky. So talk to your teams, see if there are ways that you can work on small projects and kind of like make your way through that and see if this is something that interests you. There are a lot of also graduate courses that you can take in finance. They don't have a prerequisite that you needed to have studied finance in your undergrad. So explore those courses and hopefully you're able to break into finance.
Awesome. Aashna, thank you so much for sharing an hour and presenting and preparing these slides and offering to give advice and guidance to our students on LinkedIn after. Yeah, thank you so much. I know based on the Dory and what I saw in the Slack, this was a very engaging conversation. So I hope the students follow up after and hope you have enjoyed the rest of your early week and thank you so much.
Fantastic. Thank you so much, James, for having me. This was fantastic. And the questions were very, very interesting. So I hope this session and was helpful for you guys. And as I said, yes, I'm available on LinkedIn. So if you guys have any questions, hit me up. And thank you so much.
Yeah, awesome. Thank you. And to all our students, we'll see you at 11:30 a.m. Pacific for the marketing and advertising industry overview with Vinicius. Bye, everyone. Thanks so much.
Bye.